1 2 1 2 1 2. my audio? Hello, everybody. Wait, I'm not sure they can hear you. Just one second. Sorry. Um,
Let me know.
okay, you're live now, DP.
All
Can
right.
you?
If you guys have any questions, please put them in the chat box on the YouTube link, and we'll try to answer them as we get to them. While we're waiting for questions, I'll talk about general market stuff. Is today was a very good index day, but not a great underlying day. I was talking about it all day on the chat. Is you pretty much had sells that engage around 10 a.m. this morning for most names not named: Google, Nvidia, Apple, Microsoft, and they just continued their slow, low volume bleed. So for me, there's still a bit of a lack of trend change, is what I guess what you probably heard in my commentary during the day. Is trend changes are great on the index, but individual stocks that are beaten up, like for example, let's take Zoom. Zoom was 406 before earnings, and now it just hit 250 a couple days ago, and we had a 24-point bounce from those lows, which is pretty good, but not that great for something that's been beaten up 155 points straight down on fairly low volume outside of the earnings volume that went in. So just and then hits a resistance point and just continues to bleed is for me, like there's no trend change yet. Trend change occurs when you see resistance hit and then broken, like almost immediately, or after a small flag, it just blows right through it. Like then you'll see it in Roku. Roku hit the gap resistance from the 23rd of September and then just faded the whole day. Yeah, you could say it's OPEX shenanigans and stuff like that. But if you're looking at OPEX, man, there's an insane amount of puts that are expiring in the money versus calls. It's like almost the exact opposite of 2021. But that's my general view. It's nice to see the index coming up and getting above key levels. But what we need is a more broad based kind of rally. You have individual names up 2.5%, 3%, outperforming the Qs or the SPY or whatever. But there's a lot of names that are flat for the day now, and good news is sold, bad news is sold. So it's just something to keep in mind. Um, in terms of like them selling strength. But Doobie, if you want to talk about some of your general market thoughts as well.
Yeah. So let me see if I can. For some reason, I can't share this. Let's see if this comes out. Okay. Hopefully, you can see my screen now. So the thing that I'm usually watching. So let's look. Let's actually look at SPY. So big picture, right? We lost a big trend, but if you recall what we talked previously is where is that? Just one second. Okay, never mind. So the way I'm looking at this is more of a pullback or a correction because ideally, you know, this was a nasty sell-off, but we should not have come up to here unless this was corrective and constructive and not, a start of a correction. Sure, the 50 SMA is still above us, which is concerning, right? We stopped right at the 50 SMA, so potentially this could get rejected and pushed down. I don't think that's the case, but keeping an open mind
Well,
and
we
one.
cleared the 50 EMEA, by the way, just an FYI.
Yeah, so to me, the 21 EMEA is the mean, or if you look at the 20 SMA, they're very close to each other.
Yeah,
Um, to me, the fact that it's curling up now is a good sign, right? And it's a very similar look on the Qs, right? You can see we cleared that, we're closed above that, we closed at the highs, we're still under the 50. This is the 50 SMA, and so this all to me looked like bullish with potential trend reversal, right? And GP, if we're trying to be smarter than we really are, and we are kind of thinking of, Elliott wave. So, this was an ABC. Sorry,
yeah.
all right. This
It's
is our,
similar to the May pattern and the March
yeah,
pattern,
this
right?
this is your ABC pattern, right? And then we potentially move up. So I'm bullish, surprisingly, because I'm always bearish. So this is a new thing.
I'm
Um,
taking the opposite role of you. I'm more bearish because of the underlying, but
yeah,
it's
but
still bullish overall, right? That's ultimately what it matters.
yeah, so I would say, and again, I'm hesitant because this is still OPEX week and everything could change next week. If we lose the EMA, the 21 EMA again, then we're going to see new lows. That's for sure, right? To me, that's the line in the sand. I was willing to give it some breathing room around here as a first drop below it and the first attempt to fail. But if the second attempt to cross it succeeds but then fails, that to me is a very bearish signal, and I'll probably look for the 4K on the future on the ES that everybody's talking about. Right now, I'm happily bullish, but suspicious of anything that's happening. And Google closed at highs, which is a good sign. Netflix is doing its own thing, and I think there was a question about Netflix. I'll talk about it in a few minutes.
Yeah.
And right, Netflix to me is right. This is your flag, and it's breaking out, and there is no reason for it not to go to 660 tomorrow, unless the market doesn't like me, which is more often than none happening. Um,
You need a
yes,
Goldman conviction
yeah,
upgrade.
yeah,
Actually, I don't want one of those before earnings.
yeah.
Those are
Um,
those are death strikes. So
So that's my view on the market. One of the questions that came up was, and I'll just jump to the question, is what puts credit spread, and I'll try to let's see if I can do this. I'm trying to see if
while
I
you while you're doing that, I'll just kind of um, explain what it is and the thought process behind it is like. So if you think a stock is bottom or close to bottoming, what we're talking about here is a put credit spread. So what that is um, you sell a near money put, and then you buy out of the money put is usually the thought process. So obviously the near money put is going to be more expensive, and the out of money put is cheaper. So you end up getting a net credit. So the thought process is that if it is close to the bottom, is that you can potentially generate income while you wait for it to kind of bottom and base and then start to move for its uptrend, and you generate income while you wait, right, and until you get that moment. And generally in those cases, for me, I like to see a about 75% return on those put credit spreads. So essentially, let's say I buy a Zoom um, 270, 260 um, put credit spread for November. I would like to see that trading somewhere around 750. So essentially, what you get is $750 in credit, and it costs you about $1,000 to hold that credit spread, put credit spread in terms of capital margin requirements. So the risk there is you're risking 750. So you're risking $250 to make a thousand. So you're about 3 to 1 is what I like to do. I'm not a huge fan of doing put credit spreads to generate meager profits, like under 50% and stuff like that, because I think the risk is just too much for me to hold on to that capital while I wait for it to kind of go down and stuff like that. So um, that's just my general process, and that's how I manage the risk on those. That if I'm laying out $1,000 in terms of capital, I want $750 or more in return. So the percentage is what matters to me, which gives us about a 3 to 1. So it could be on any spread. It could be a dollar spread. It could be on a $5 spread, a $50 spread, whatever it is whatever it is you decide to sell. That's kind of how I approach it for myself.
Yeah. So the I think it might be easier if it's still confusing. So right, let's start with directional plays, right? And I picked up Apple simply because it's a chart that I don't usually chart, so it's clean. So let me just remove all the moving averages. This is the last one. Okay. So, if I'm excuse me, if I want to play Apple, if I'm playing it up, then I'm going to let's do this. If I think Apple goes up, I can buy calls. I can buy call spreads, right? The calls, let's say I think Apple goes to 150. I can buy 144, 145 calls and wait until they're, 5 points in the money. And that's our simple naked call play. The same goes with puts, just on the other direction, right? If I think Apple is going to go down, I'll buy puts either out of the money or in the money, and I'll gain as it goes with me, I'll gain more. Spreads are basically you box your trade, right? If I decide that I wanna limit my risk, and TBI is very good with this, is then I'll buy this call, but I'll sell this call. So my max gain will be the range in between, because the moment this call goes into money, then both calls would appreciate in value. The lower will appreciate a little bit more, the higher will appreciate a little bit less. But as you get out of the money and two strikes are in the money, your max gain will be, 1 to 1, which is, let's say it was 157.50 and 145, your max gain will be $12. The same would go for buying a put debit spread, that you buy the put and you sell the lower put, limiting your potential gain. This is all fairly intuitive. When you start talking about selling, this is where it becomes complicated. So if I want to sell or do a call credit spread, this means that it's a bearish play, that I believe that it will not go above those two strikes. So it depends on what credit I'm getting. And again, let's pick something that is easy to digest. So let's say that I'm selling the 145 calls and I'm buying one. sorry, I'm selling the 145 calls and I will buy the 155 calls. That limits the maximum loss on this to 10 because at worst case, if both strikes are in the money, this maximum spread will be $10. If I sell this spread for, let's say, 7.5 today, then my max loss would be 10 minus, I get $7.5 today. At worst case, I'll need to pay up $10, so my max loss would be 2.5. The same thing would go on the downside. I can sell a put credit spread if I don't believe this will ever go under, right? If I can get some credit here, then I will, and again, let's do it in round numbers. I would take it to 140, 130. I will sell the 140 put. I will buy the 130 put to protect myself because tomorrow the SEC opens up an investigation on Apple and this thing dives to, 50. Um, so that limits your loss on what you sold to a maximum or max loss here, or the maximum worth of the spread will always be the intrinsic value, which is 10 points. If I can get credit on this spread, let's say $5, then my risk is 1 to 1. I can either lose $5 or gain the $5 credit that I got. So if we take an example and I pull the option chain, it should come up. I don't know if it will be visible or not, but let's look at Apple for tomorrow. So Apple right now is at 143. So let's say I want to sell. So there's not too much value here. So I can sell in the money put spreads. Let's say I believe it's going to go up. I'll sell 150 for $6 and I'll buy the 145 for a buck 40. So that will be $3 credit that I'm getting, right? And at worst case, and I'm probably messing up the math here. At worst case, this is going to be worth $5. So I'm getting $3.50 today, and worst case I'll lose a buck 50 or a buck 40. Best case I keep the 350 that I just paid. I don't know if that makes sense or not, but I hope it's helpful. Ask me additional questions if on chat. Um, best
Maybe
strat.
TBI's on if he wants to share his credit
I,
strategy.
I need to bring him on audio if he wants to. Hold on. TBI, you need to join the Skype session so I can stream you into the YouTube session.
I am on Skype.
Oh,
Can you hear me?
you're on Skype. Okay. I don't know if they can hear you. Let me check. Okay. Okay, so we have TBI for a brief.
I'm here until 2.
Okay, perfect. Okay, next question that I see here. Best strategy to stop out, please. After 30% loss on a ticker, or a strategy, the hit is too hard. Any rules of thumb to stop out? I would say that you're trading too big if 30% loss on your position is becoming too significant. And I'll let GP and TBI weigh in, the way I'm trading is most of my position, the stop is my position. So I'm entering a position with the assumption that it can go down to zero. Of course, I'm not excited about it, but it's something that, my position size is my stop. But playing with options, it's such a leveraged play. If you're getting nervous about 30% loss, you're trading too big. TBI, GP, do you want to weigh here?
Yeah, I 100% you're trading too big, or just move to commons if you're going to take a 30% loss. Like I'll say I've bought options probably thousands of times, and within 30 seconds after buying, they're down 30%. It it just seems to happen. You'll be down like 10% just trying to get halfway between the bid and the ask. So I think that's just a mental kind of hurdle that a lot of people who don't regularly trade options tend to come come across when they first start. I know I did when I first started as well. Is it's like shit. I bought it and it's already down 10%. And you buy a $2,000 position, you're down $200-300 immediately, and it kind of sucks to watch. But I think the advice uh, that Random's talking about, which is your position size is too big, is absolutely correct. If I'm willing to lose $1,000 on a trade, that's my position side. I'm not gonna buy a $3,000 position and watch it stop me out at 30%, lose $1,000, and then go 30x in the next day, right? That's just not. I've seen and done that way too often that it hampers my mental capital over time. So I tend not to do that. I rather just buy $1,000 position and let it play out. And week in and week out, there's a lot of stuff that can potentially expire worthless, but that's also within my risk parameters. Some people can't handle that in terms of how they look at trading in general. So then you can have a stop out, and you gotta. I think percentage stop outs tend to get you out of the position before you get the position to work out. You'll see, for example, Roku is one I have for next week, and the whole day the calls bled. They're down, I think 20 or 30%, while the stock was still green for the day. So the setup's still there, but the calls bleed, and I would have gotten stopped out. So I just don't. I play the setup, not the P&L, and the P&L is what usually people who first start is what they're playing, and that I think it hurts performance over time. Go ahead, TBI. I'm done.
Um, so I wanted to pick some examples here. So let's see. I started posting my stop loss, strategy. There's no real, I mean, you could go with what Random said. He sizes his position in a manner that he could write off that entire position if it goes against him, right? So if depending on your portfolio size, I mean, if it's, let's say if you're trading a $25,000 portfolio, right, a $2,500 loss on a given trade is too high, right? But if you enter a spread, for example, and it's $100 spread, I don't think you need a stop. Especially if your risk to reward is, let's say, you make $300 on a $100 investment, and you're trading a very strong support level. So I think that's going to be the key. It depends on when you enter a position. A lot of time, you guys don't have the benefit of entering a position exactly at the same time that we do. So by the time you enter a position, it's already moved up 10, 15, 20%. So if we say a stop loss at 50%, your stop loss is really at 30%, because your entry could be 10, 15, 20% higher than our entry. So a lot depends on that. But again, I would recommend that size your position in a manner that you could write at least half of, so size it accordingly. Most of my stop loss, on recent trades that I posted, they are extremely conservative. Not only am I trading spreads where the upside is fairly limited, but also, your loss is limited. Plus, I'm putting in a stop loss at 50%. So it really depends on your portfolio size, your overall exposure, and what type of technical trade are you trading. If you are trading, let's say, for example, beyond, which we've cursed enough, I guess, as a group. If you're trading it at 100, and if you try to get, what I've gotten, the 100 put 98 put spread, it's holding that level. I entered that position at 104. I'm fairly confident that it's probably not going to break 100, especially after that kind of a base. So what I did was I sold the 100 put and bought the 98 put. So as long as the price stays over 100 by expiration, I'm fine. I collect that net credit. That's an example. Do I need to put a stop? Probably not. It's $47 per contract. I've entered 50 contracts on that position. Just FYI. So I'm looking to make $47 per contract into 50 on that trade, you know, just because I'm entering a position that has based around that 100 spot for the past 2 or 3 weeks. And there's upward buying pressure building up. So I'm fairly comfortable holding that position. But if it goes against me, something goes wrong with Beyond and it opens up $95, on a given trade, I'm okay writing that entire amount out. So
So yeah, can you just identify the risk on that, TBI?
so
Like
yeah, so the,
if by expiration both Beyond is sitting at 95.
right. If Beyond is sitting at 95, your STO leg, both legs are going to be
Here,
in the
you've
money.
got. I put out the chart, and I'll just block it.
Yeah,
So you sold 198.
I sold 100
Okay,
and
so
bought a 98.
yeah, so this is your spread. Oops, sorry.
So my maximum exposure on this spread is 1.53 per contract. If both legs end up in the money, I would lose 1.53, right? Which is why this is a low reward, high risk trade if we are trading it in the middle of nowhere, right? But stocks that have been beaten up and have based around a long, for a long time, and you know that it's going to hold that pivot no matter what, right? Or at least there's a high probability of holding that pivot. That's when you enter a position like this.
Okay, so just to visualize this, so basically this is the 100 puts that he sold and the 98 puts that he bought. If the if by expiration it closes above this line, then he owes nobody nothing. So the spread, and it might be easier, if you're new to this concept, think about buying this spread. So let's say there's always somebody on the other side. So somebody bought this spread thinking that it will close under 100. So he bought 100 put and he sold the 98 put. So if it closes in the money, then the worth of the spread will be how much in the money it is. So let's say it closed at 99, the spread will be worth a buck. If it closed at 98, the spread will be worth $2. If it closed below 98, it will still be $2 because he sold the 98 calls, the 98 puts. So that's the person on the other side of TBI's trade. TBI is the other way around. So if it closes at 99, he needs to pay somebody a buck for the spread because it closed, $1 in the money. If it closes at 98, he needs to pay somebody $2 because it closed $2 in the money. If it closes at $10, he still needs to pay only $2 because he bought the 98 put as protection. So the maximum money that he's going to be owing on this spread is $2. If it closes above 100, he doesn't need to pay anybody nothing. And if it closes within the spreads, he just needs to pay whatever how much in the money the spread is. Now, if he, the beauty about spreads is when you sell them, you get a credit immediately. So how much money did you get for it, TBI?
You're on mute.
Oh, he's on mute. Do you know how much money?
Yeah, 47 times 50, so 300 at 2350.
No, but how much per contract? So he got 47
47
cents.
cents. Yeah.
47 cents, so $47 a
Yeah,
contract
yeah,
times the total number of
yeah, yeah.
contracts.
So,
That's
so,
what the credit we get.
so your break-even point is if it closes above 99.50, roughly.
Correct.
Yes. So
Yeah.
my, so basically and it's with selling put credits or put credit spreads, the math sounds a little bit off because he's risking a buck 50 to make 50 cents, but the probability and the time works for his, in his advantage. The one important thing about spreads is that, you really shouldn't be a dick for a tick because, more often you will get in the last, hour of Friday some nasty moves, and it's not unheard of. I still remember somebody was, some Friday Facebook dropped like 10 points in the last 30 minutes. So you're sitting, and this is why I don't like to play those plays, because you're sitting and it excuse me. It just you're playing the time erosion, and your max gain will be at expiration. But let's say you get, this will drop from 50 cents to 30 cents to 20 cents to 10 cents, and you're saying, well, I'm just going to let it expire worthless, and then the last minute it just drops, and you going into max loss immediately. So it's a good practice to close it, or at least scale out as as profit comes out. So if you sold it for 47, if you can buy it back for 10 cents or something like that, don't wait for it to expire worthless. Just bite the bullet and close it.
Correct. They have 15 minutes after the market closes to exercise the puts as well on a Friday. So keep that in mind. So if you get some after hours move as well, forget like during the day, but something comes out, which usually does at 4:01 p.m. On a Friday or whatever, and it drops $10 or something like that, you're going to be required to pay it out because they might execute that trade, and so you can get caught
They exercise
flat-footed.
the trade and then they execute you. But
Yeah, so you can get flat-footed. I think part of this put credit spread is also the capital requirement for TBI's beyond trade. That requires $10,000 of capital to keep the 50 calls times $2 spread is a $10,000 capital requirement that you got to have in your account that will be there until they expire worthless or you close them. So
yeah,
just
but
if you
you
keep
can
that in
do
mind.
you can do 5, you can do 10. You don't need to do 50.
Yeah.
So
Right.
No, I'm just using it as an example
yeah.
in this case, but in whatever case, even if you did one, you would have to have $100 in your bank account, sorry, in your trading account to match that requirement until they expire or you close them out.
And
So
then
like, so
I
go
don't know
ahead.
if I can share my screen, but if you
You
guys are
can.
on Discord,
So share your screen on Skype, and I'll broadcast it into YouTube.
okay. All right, give me a second. Let's see what do I do here. Doesn't give me that option. Oh yeah, here it is.
Okay, just give me a second to see if I can. One second.
While we're waiting for this, we should probably uh, move into the other questions shortly because we're going to run out of time.
All right, I'm back, and I'm
Yeah.
gonna. Sorry, I had to restart this.
Oh, okay.
Can you share? Can you?
No, I don't. I can see. Hold on. One second. Oh, here it is. Screen share. Okay. Let me turn off my display capture.
Speaker's
Apologies.
still pushing.
Technical difficulties. Okay. There you go. Okay,
I don't see it yet.
it will show up
Yeah,
in a minute.
I can see it on Skype. It's a delay on YouTube.
It should show up in YouTube in a minute.
On my video got disabled on Skype because I'm screen sharing. Okay. All right. So you guys can see the horizontal. Is it clear to everyone? I mean,
Yes.
DB, is it clear because it's appearing?
Oh no, it's not clear. Just talk through it.
Okay.
You showed the chart on
Yeah,
on the Discord
shared the
too.
chart
So.
on Discord. It's the lower line, that horizontal, support. And this was supposed to be sort of like a breakdown setup, right? A descending triangle is a bearish setup, typically. But in this market, almost every descending triangle that I've seen, over the past, since March 2020, has invalidated. And then it's invalidating here as well with this move today, which started yesterday. So I am essentially increasing my risk. I mean, look, if the stock gaps down, there's no control over that position. But as long as it doesn't gap down, or I mean, we can't hypothesize or predict what potential catalyst might drive the price down. But the position is essentially that horizontal support line, and I'm saying that this is going to close the week above that support line, especially because it's breaking out of this descending triangle, which was a bearish setup, but now it's invalidated that bearish setup, hence the position. Now, I could always stop out, right, at any given point in time. If the price goes against me, always have that decision. Right now I'm sitting on around 22%, profit on that position. And I know, we have 13 more minutes, so happy to take, more calls. I've answered a few questions of yours, Kurush, and all right. Is my voice echoing?
I don't hear an echo, but I guess they do.
All right, I'm going to stop sharing my screen. Doobie, it's not clear. So I'll
Yeah, I fixed the echo. Sorry.
So, so I'm going to address what OPEX is. We had only monthly options, so it's every third Friday of the month, and that's where that's how we used to trade. It's kind of crazy if I think about it now that we only used to trade monthly options, but so it's where usually you'll see where the big money kind of comes in. It's where it goes. It's if you're holding a position, or if you're bullish, you'll usually see them hit the monthly OPEXs, not weekly. Once in a while, you'll see it with the bullish flow that's been going crazy over the last 18 months. But that's what monthly OPEX is. It's monthly options expiration. That happens every month, third Friday of the month. It's where lots of money kind of sits. Like you'll see it in names like Verizon and AT&T and those ones that got beat up or whatever it is that's happening.
Here,
right
I've got the option chain on the screen, so if you wanna, I can pull out. Which one do you want to look at? Verizon?
Oh, yeah, we can look at anything, but you'll see lots of you'll see a lot more pinning in those types of actions because there's so much money at stake that these guys are selling or buying or whatever they're doing. We don't know. We try to guess based on the bid and ask, and that's what I talk about a lot. And I've been spending a lot more time on it recently because it's been really it's really out there these days. The Amazon spreads I was showing, they're literally buying thousands and thousands of spreads that expire tomorrow, right? Like this is, and it's not against any OI or stuff like that. So I've been really curious about it because it's a big shift for what I used to be able to see on this stuff. But that's what OpEx is. It's just monthly options expiration where a lot of big money sits. So more chances of pinning, um, whether they want to collect the premium or not. That's kind of where it's sitting.
Yeah. So
Uh,
Does that, I hope that answers your question, John.
William asked about Weber. I'm just moving on because we're starting to run out of time. So Weber looks great. It just looks like right. That's your IPO base, and it's you can argue that it's broke the trend here. It's starting to move up. It's starting to gain traction. I'm looking for at least 2044 to come through quickly, and then I have extensions at 22, 21, and 24, 47s. That's your fib extensions, and if this was indeed the consolidation range, then 50% targets put you at around 26. So it's a decent play on common, as well as I've got some November 17 and a half, and I've got some tomorrow 17 and a half is Lotos. So Weber is actually behaving very well. The one that's not behaving well is Uploving, and it's not behaving well. Or when I'm saying it's not behaving well, simply because it's not doing anything. It's just drifting higher, which is not what I would have expected it to do so far. So today it cleared all-time high, which is great. But I would have expected it to bust a 5-10 point move from here, and it just 90.1, 90.15, 90.20. This is not the action that I would expect from an IPO breaking out from a base. So not overly excited about this one. Um, I don't know if there's any other question. I'm just looking here. Um, Sunil is talking about weekly trades, a little less than a week time frame. Once we follow alert, get in the trade. What strategy or a specific recommendation to follow before a trade goes against you? So we talked about it a little bit. The what I do is basically my position is my risk. And typically I would go into a position with smaller than my risk, and so I can add if it goes against me. And you can see that I'm adding quite frequently. And TBIGP, if you want to talk about that as well.
Yeah, it's the same thing for me as well. Position size is what um, is how I kind of handle it. I've been just stopped out of so much stuff when I first started, and then frustrated by the day after it expires or whatever it moves or whatever. So um, I just use my position size to be my trade risk profile. So if I have a $10,000 portfolio, I'm not putting $10,000 on the trade. That would not be smart. I'm putting $500 on the trade, right? So it's a 5% of the portfolio. I typically, the way I used to do it and kind of still do, it depends on how I feel about the chart and stuff like that. But usually I want to take the total portfolio size and divide by 20. So I want to have the ability to have 20 different trades that my portfolio can kind of withstand, even if 5 go against you. That you're not broken. But that's kind of how I usually split up the trade. So like you can obviously lower the percentage as your portfolio size gets bigger, so you're not risking as much money, or however you want to do it. But that's typically how I started when I was a small account. It's about 20 trades is what I want to be able to get out of that one account. If it's 10,000.
Yeah, so Netflix, just a quick update on that. So right now, if I look at this pullback, and we talked about the flag a little bit earlier, And earnings next week. So once we clear, there's the 618 retracement here, which is basically what it's doing right now. Once we clear this range, most probably we'll head up to 646. And I'm looking at this is a 1 hour chart. This is a 2 day consolidation. So it's not unlikely, it's not unreasonable to expect that if the market holds tomorrow, this could easily hit the 662 mark. Um, but the market has to work for us and not against us. There is additional resistance, I think, here at 664, which is some bigger extension. Let's look at the weeklies. It might clarify what we're looking at. Um, oh, it's coming from here. Yeah, so this is the major swing, the 593 to 478, that 1618 extension. So I don't think we'll get to earnings above 664, but 662 to 664 is a reasonable target to go into earnings. That's my gut feeling. Call it a
And
hunch.
the strength is just phenomenal. That 626 level that we were talking about, that's the one from last Monday where it broke out and then immediately died. There's a lot of volume on that candle, so that's why I've been watching the 626 level, which 1, 2, 3, 4, 7 days in a row it's held,
Yep.
um, and it continues to flag above prior like prior bases, which is just showing you the strength that people are refusing to let it go down more, and they're trying to get in as much as they can. Which and that can all change on earnings. So don't like we're
Don't bet the farm or the
yeah,
house.
don't exactly don't bet the farm. We're bullish going into earnings, and we're bullish even after based on prior technical setups. But if they crap the bed on earnings on Monday, it's not going to matter what bullish scenario was there beforehand. So just keep that in mind when we're talking about risk as well. Like if you want to be a bit more heavier in the position, fine, but don't let it destroy your account. So there's a question about indicators as well. Over time, the more I trade, the less indicators I use. Only really use RSI and MACD. And to be honest, I don't even really look at RSI because it can stay overbought or oversold for a very long time. When it's a sustained overbought, that's when I start paying, or oversold. That's when I really start to pay attention because a mean reversion setup is there, but it doesn't dictate my entries or exits. It's one of the reasons I'll be watching, but it definitely doesn't influence me in ways I take trades.
Yeah, I didn't look at RSI either, mainly because you always have more of or overbought there when you're overbought. And the important thing to understand about RSI is it's a good indicator for chop. So when when there's balance that you're chopping back and forth in a range, RSI is a good indicator to play because it tells you, when you're at the bottom of the range or when you're at top of the range, when to go in and when to come out. When you're trending, that's by definition an imbalance, right? Because you're drifting higher or you're going higher, then RSI is less accurate in that case because it's not you're not range bound. So that's why, and
Yeah.
I like to play. I don't like to play chop. I like to play trending stock. So RSI is less helpful in that case.
Question from Active Life TBI. Sorry, do you want to add anything?
I do look at RSI only when it's oversold on quality names. For instance, I think when I took the Melly trade, for example, the call spread that expires this week, my entry was at 1450. RSI was reeling at 20. We had to really look back 6 years to see RSI on the daily so oversold. So that was my one single point of entry, is that this is way too oversold. and I actually started, a common stock position on it, a little higher at 1489. So I wanted to back that up with an option spread, which I felt that now they've really beaten the heck out of it. And then what I did was I looked at the previous earnings. I went through the earnings report, and the stock was trading at 1970, and it felt like it was going to break out to 2400 range, and now here it is at 1400 something. Um, so you know, it's Melly is one of those tickers that's explosive. It's like Shopify, when it was trading at 1,000, and then it took like what in a matter of 2 or 3 weeks, it jumped from that spot to 1650. Melly is that type of a stock, for me. So, I did enter, I looked at the RSI reading and I'm like, this is unreal. It's a rare setup. We really have to look at, a multi-year chart to see, how oversold this has gotten. But like GP said, that doesn't mean that, it can't stay oversold for an extended period of time. BABA, for instance, it got oversold and it stayed oversold for a lengthy period of time. But then you also see a 32-point move, from that bottom base in a very quick time. So yeah, it depends on what name it is, really. I mean, Melly was too good to pass at that level. I also have a 1600, 1700 call spread, that expires in November, which is already up like, I think around 60% already. So yeah, so I do look at RSI. It is always on my screen. I think most traders, have that, it's one of the three things that they track on a chart.
Yeah. So there's a question. I want to move on because we're running out of time a little bit. Sorry, TVI. There's a question from Active Lifestyles. A question about profit-taking strategy. I'll keep it pretty simple. My profit-taking strategies is if it doubles, I sell half. I get my capital out, and I wait for the rest of the trade to kind of take place. If I'm taking a trade and you don't get the double and it's like 20 or 30%, but you start to see some pretty solid resistance coming in at like a moving average or something like that, I start to scale out or I close it out. That's what it depends on. Um, but yeah, I normally take out my capital on the first half immediately so I can function and just watch the trade through. That's just how I take profits. TBI.
Yeah.
Profit
Sorry, I
taking
was
strategy.
I think
Profit taking
TBI
strategy.
answered in the chat, but so
I think I entered. Yeah, I answered. I mean, I usually I kick myself, because then several times I'm in a position that random is also in a position, and I've opened up a call spread, so I've limited my upside. For instance, Google, the way it moved today, he's booking 20 baggers, and I'm looking at 200% profit. So yeah, I mean, on days like that, call spreads are really it severely limits your upside. But at call spreads, what I've realized is that I can add more position to, naked calls or naked puts. I can operate with 2 or 3, sometimes 5x, the positions that I'm normally comfortable with, just because I know that, I mean, if it chops, if it goes sideways, I have that STO leg, the collective premium, holding on to my original bias of if it's a call spread or a put spread. And what I've also realized is that a call spread, helps me stay in the position for much longer because I try to trade call spreads ATM. So when both legs go in the money, then I'm looking at maximum profit, which I'm very comfortable with. It's a strategy that has worked really well for me over the years. When on naked calls, I start booking profit at 100, 150%. If it gaps up and goes, then I'm usually patient, on a trend up day or a trend down day, depending on, what side I'm trading. I usually try to not sell, in the first 15, 20, 30 minutes. It's very volatile, so I let things settle down. But usually I start booking profits at, somewhere between 100 and 200%. I usually do not book profits at 50%. If it's at 50%, it tends to run a little higher depending on what name we are trading. Usually we are trading quality names, blue chip companies, and we are trading at strong pivots. So if it confirms the bias, I tend to hold it at least for 100% profit, and then take out another quarter as it keeps running, and then leave runners until the day of expiration, which is when I book my final profit.
Random.
Yeah, I just don't take profits.
Until you get 20 bags, right?
No, but seriously, this is please, and I keep telling people on direct messages and all of that. Don't follow my exits. My risk tolerance is probably different than yours. So, pick up a strategy that works well for you. Taking half at 2x, taking half at 3x, taking half at somewhere is a decent strategy to play by. I usually look at pivots and decide where I'm going to start pulling off profits, and I'm sharing those levels typically on either the playbook um, or the what do you call it, the on main chat. And the reason why I'm doing this is because the way I'm looking at the trade is, I'm trying to get to a specific target, and once I hit that target, I want to take some risk off the table, and it has nothing to do with the potential gain on the position, right? It's one thing that dawned on me here early on is that I could have went into the same trade 10 minutes earlier, and now it would be 300% up, and now I'm only, I went in when I went in, and now I'm only 100% up. So I'm looking at this more as what's my target and where I want to go. And then when I get close to the target, I'm looking at how it behaves around the target. Does it start fading, or does it, flag around that? And it's always a judgment call that's not that straightforward. So you'll see a lot of positions that were in the money that I'm holding that, go out of the money. Like I could have sold Roku today for a decent, 2.5x. But since Google worked out well, then I made the judgment call that, I'll just hold Roku for whatever. The same for Zoom. Zoom was
Or
did
beyond.
or Beyond. No, Beyond. I don't care about what Beyond does until Monday. But
I thought you had the 110s.
no, no, I intentionally avoid buying. The only time I'll buy OPEX Beyond positions will be on Friday at midday. So if it repeats the pattern, it will pop tomorrow to trap a few more, victims. Then it will fade, or it will just gap down and fade. And at some point midday, it will reverse and start drifting higher. And that's usually a pretty decent spot to get it. It's very likely that it will close above 110 or 108, I think is a possible thing. So if it goes down to 103 or 104, that might present a nice lotto opportunity on it. But the point, and this is important because people are following some of my trades, don't take my exits. Pick up whatever pivot that you want to do, and if you're getting 2x or 3x um, more frequently than getting 10x is perfectly fine, and you'll probably be much more consistent. And then you can let profits compound, which is probably going to work out pretty well. So always take risk off the table as quickly as possible. It could be a good practice to, once you enter a position, to put immediately a good to cancel order to take the position out. That's a pretty decent practice that you can do. There's different strategies around that. I've seen people that they set their whole exits based on return, so they'll put half a position at 2x, another quarter of a position at 5x, and another quarter of a position at 10x, and then just go to the gym and don't care about whatever happens. Um, Find out what works for you and just go with it.
Yep. It's almost time, so I think we should probably just have another session next week if we can. Um, I know we got some hard stops here, so I just want to make sure that we kind of wrap up here. Um, if you have any questions, we're always available in the chat, and we'll answer what we can. We've talked a lot about a lot of the stuff here in our chat from 2020. Go back and search. You'll be able to find, look for keywords and stuff like that. You'll be able to find some good stuff. We have some stuff pinned as well. Um, but it's your personality ultimately that matters on how you take this risk tolerance, how you take trades, how much you risk. It's all really based on what you're willing to handle. Some people will come in when it's too late and worry about how the market is always against them. But you wait for all the things to align that are perfect, you're going to be that guy that they're selling it to, not buying it. You're not the guy buying it. So sometimes, and I think that's just comes with chart time and experience. Personally, um, you'll see all three of us buy some stuff when it looks like it's bleeding profusely, and wondering why we're doing that. And it's just what we've seen over time.
Yeah, I just wanted I saw one more question from John from early on that I
Sure.
wanted to comment on. So what's the advantages or disadvantages to selling a credit spread? The important thing, and I think that's the premium collection part of it, is that, if let's again look at Apple here and talk about selling a credit spread or buying a directional position for next week, right? This would be your expiration. So the key point is, if I buy a 140, even in the money call, if I buy 140 call and Apple just continues to chop around here, I will lose money because I'm paying for that time until expiration. If I buy, the same would go for puts, just the other way around. If I sell this put credit spread, right, the 140 to 145, since I'm in negative delta or negative theta territory, then time works to my advantage, right? I've sold a put that depreciates with time as time goes by. So I don't need the stock for me to make money on a directional call. I need the stock to go up faster than the time decay on the premium. If I sold a position, I don't need the stock. The only thing I need the stock to do is not drop below my break-even point. So it's in if you continue chopping around here, the put credit spread will make money. The long call will lose money and probably expire worthless. So that's another element, that if the market is just chopping around and everything, selling credit spreads, it's typically a safer way to collect premium than buying directional calls. So that's to
Yeah.
answer the question of what's the advantages or disadvantages. The disadvantage is that, as TBI said, is it's wonderful to have 5 points here and get max gain, but then Apple announces a new car and it goes 20 points up, and you're just beating yourself. What the hell did I do selling the 145 calls?
Yep. And keep in mind, if that something like that happens, you can always buy back the sold call for more than you paid. Not usually not a good strategy, but there's ways to kind of handle it as well. Or you can just buy out of the money calls, right? Keep the spread as is,
Yeah.
and then and you can buy the 150 calls at that point, right? So if you think it's going up, you can still participate. You just don't have to do anything with the spread. So there's ways you can handle and
Yeah,
manage
yeah.
that position as well. So
So I saw a question here from Kurush. I hope I'm not abusing your name too badly. What's your target for Google for the earnings? So what happens in earnings stays in earnings. I have no idea what's going to happen in earnings. Um, Target for Google until earnings, which is not necessarily what's going to happen tomorrow, is, so I'm looking at this. Let's just so this is my view on Google. right? Bear in mind we're outside of the channel, right? This is not a healthy situation. This is your Google channel that it's been trading in for a long time, and now we're outside of it. If we reclaim it, that's a pretty bullish sign. So you can look at the top of the channel, which comes up around 3100 as a decent target. If I'm looking at other methods to estimate where Google is going to go to, so besides fib levels and all that crap, you can look at, right, this is your ABC correction is here, and now we continue upwards. If, again, looking at Elliott waves, I can just say this would be subwave one of the bigger move. This was your ABC correction of that wave one. The next wave three, is the bigger one, so it should be as big or larger than the previous wave. So I'm taking this low to this high, and I'm drawing it from here, and I want to see where that gets me. Let's see if it's, well, it didn't get me anywhere. Just 1 second. Okay, let's do this again. So I'm taking this low to this high, right? And then I'm looking from here, a 100% projection of this move from 26.24 to 28.14 puts me at 28.99, so around it to 2900, which I think is doable by tomorrow if, again, market doesn't crap out. But for next week, right, if this is wave one, this wave is typically 1.68 after wave one, then you can look at potentially, 2980 to 3000 before earning. Um, will it happen? I don't know, but that's if we get close to that, that's probably where I'll start taking risk off. So I don't know where it's going to go. I think I think it had nothing to do under 2790, which is the 50 SMA. The way it reclaimed it today gives me comfort that it's they're still buying it. Breaking this trend is a good sign to me.
It broke
And
the downtrend, right? The daily downtrend.
yeah, so you see this, it's very clear here how it broke it. And the last time it did this garbage shake off was here. Where was that? Let's see. Yeah, so this is, I think, where it kind of, it trapped a lot of people bearish, and then it just continued higher. I think we're going to see another repeat of that. So I don't expect it to explode, but getting from, again, looking at the lows here, that was 2200, it got, in a matter of a couple of weeks to 2460. That's 20% move or 10% move. So yeah, I think to get from 2700 to 3K is within the realm of possibilities. But we need to reclaim, this is at 2840, so we need to reclaim this trend line, then clear this high, which is 2846. So 2840 to 2850 is hard. Once we cross that, then we can talk about 2870 to 2900. Okay, I hope we answered all the questions. And again, feel free to ask us on chat if you have uh, if you have any other questions.
Thanks everyone for attending. We'll do another one shortly. We'll try to make this a lot more reoccurring.
No, we've
Um,
been keeping it every 2 week schedule, at least twice. So tw- 2 points is a
yeah,
trend.
yeah. 2 weeks is a trend. One day is not a trend. I just mean like maybe we can do a bit more like on a weekly kind of half an hour, 45 minute
Sure.
answer some questions. So we don't have to wait 2 weeks to ask questions.
Yeah.
So yeah, we'll try to do more of it as our schedules align better and our technical difficulties slow down a bit.
Okay,
Thanks
guys.
to